market timing. So this is a lot of this is understanding, what the overall market is doing. Um, like right now, it's a good time to be patient, as far as market timing goes, because we're currently in a correction. And the market timing is to wait until we correct and get in at the bottom. We're probably not at a bottom right now, but once gold gets over, say 1950, then if you're going to do market timing, that's a really good time to get in, because after we get to over 1950, we're probably going to go to 2100. So those timing the market to get these good entry points is really important, especially if you're a trader, because then you can, immediately, if you time it right, you can immediately go up, 20, 30, 50%. And then that allows you to put that trailing stop in there to prevent significant losses. The more gains you have in a stock, the more, uh, you know, profit you're going to lock in, or lack of a loss you're going to lock in. Um, Data is that is good for gold silver prices. Okay, so when you're looking at the overall market, when you're trying to time it, you want to look at the economic numbers. So what's good? Weak economic numbers like the PMIs, jobs, stuff like that. Weak economic numbers are always good for gold because it creates uncertainty. Weak dollar, they always trade inversely. Sometimes they trade together, but by and large, uh, on average, they trade opposite each other. Low interest rates. So this one's kind of interesting. So negative real rates are always good for gold. And so when you get low rates, then you tend to get negative real rates because inflation is higher than interest rates. But conversely, we're now in a situation where high interest rates are actually good for gold, but there's kind of an in between. So the in between is not good for gold. So let's say the 10-year, if we get to like 1.75, well, actually, right now it's getting to the point where any the 10-year, if it goes down, you have negative rates, which is good for gold, and if it goes up, um, you create uncertainty. So it's like interest rates are benefiting gold all around at the moment. I don't know how long that's going to last, though. Um, but negative real rates are always really good for gold. High inflation, that's good for gold, and then uncertainty. So those are kind of things you want to look for market timing. Um, it is important that you follow business news and various data points. So this is all about market. If you're going to do market timing, you want to really have a really good understanding of what the gold and silver price has done, not just this week, but last year, the last 5 years. You want to follow it on a daily basis. You just want to have a real good feel for the gold and silver price. The S&P 500 and the Dow indexes, I think you should follow those on a daily basis. They're going to help you to understand the gold market, GDP numbers, unemployment numbers, sector numbers. So we got housing, autos, technology, consumer spending, healthcare, all these sectors. The reason why you want to follow them is because when they're weak, that creates uncertainty, creates strength in gold. When they're strong, that's when you get what we have right now, which is a risk off trade. When you get a risk off trade, nobody cares about gold. If we have a risk off trade, everybody's going to put their money into the stock market. It's like, oh, there's no risk in the stock market. I can buy whatever I want to buy. I'm going to make money. So you got to be careful. Watch those sectors, and they'll give you a feel for just how much of a risk off trade we actually have at the moment. And then the trade numbers. The trade numbers kind of go hand in hand with these sectors. The PMI numbers, I always follow those, and your income growth. PMI is your manufacturing numbers and even your service sector. Those give you a really good, those are like indexes for the overall economy. It's kind of the heartbeat.